All right, listen carefully because this isn't noise anymore. Something important is shifting quietly inside the global financial system, and most people are not paying attention. China is stepping back, Europe is heavily exposed, and US assets are starting to feel pressure that has been building for years. For a long time, the US economy benefited from a very simple but powerful system. The world needed dollars. Countries earned dollars through trade, energy, and global commerce, and then they recycled those dollars back into the United States by buying US Treasury bonds and other dollar assets. That steady foreign demand kept US interest rates low, borrowing cheap, and asset prices high. This system allowed the US to run large deficits without immediate consequences. The government could spend more than it collected, corporations could borrow cheaply, consumers could take loans easily, and markets could keep rising. As long as global confidence stayed strong, the system worked. But systems like this don't break overnight. They weaken slowly, quietly, and then all at once. China understood this earlier than most. Since 2022, Beijing has been steadily reducing its exposure to US government debt. Not suddenly, not emotionally, and not as a headline-grabbing move. This has been a calculated strategic shift. Over time, China has cut billions from its US Treasury holdings, bringing them down to around $680 billion. That's the lowest level in more than a decade. At one point, China was the largest foreign holder of US debt. Today, it is clearly moving in the opposite direction. From Beijing's perspective, the logic is simple. Why continue lending money to a country that is openly trying to contain your economy, restrict your technology, and reshape global supply chains away from you? US debt no longer fits China's long-term strategy. Instead, China has been reallocating capital into gold, strategic commodities, domestic infrastructure, regional trade partnerships, and real assets around the world. These are things that cannot be frozen, sanctioned, or inflated away easily. US bonds, once considered the safest asset in the world, are slowly losing their appeal for strategic rivals. And when one of the largest buyers steps back, markets feel it. Inside the United States, the impact is already visible. Treasury yields have jumped in a relatively short period of time. In bond markets, even small moves matter, and this move is not small. Rising yields mean higher borrowing costs across the entire economy. Mortgage rates rise, business loans become more expensive, government refinancing costs explode. Growth slows not because of a recession headline, but because money itself becomes harder to access. For ordinary Americans, this shows up quietly. Higher monthly payments, slower hearing, more expensive credit cards, less room to breathe financially. But most people don't connect these everyday pressures to global capital flows happening thousands of miles away. Now look at the US government's position. Last year alone, interest payments on US debt crossed $1 trillion. That is not a projection. That is not a future estimate. That is already happening. The US now spends more on interest than on national defense and more than on many major social programs. And those interest costs are still rising as old debt rolls over into higher rates. This is the pressure point few people talk about because it doesn't fit into short news cycles. Debt itself is not the immediate problem. The cost of servicing that debt is. As yields rise, the government faces an uncomfortable choice. Cut spending, raise taxes, or rely more heavily on money creation and central bank intervention. None of these options are painless, and all of them carry long-term consequences. Now comes Europe, and this part is even more important. Europe has not made loud announcements. There are no threats, no dramatic speeches, and no official warnings. But European investors, institutions, pension funds, and central banks hold more than $10 trillion in US dollar assets. That includes treasuries, corporate bonds, real estate exposure, and US equities. That level of exposure is enormous. Europe does not need to dump US assets to create pressure. Even a gradual shift, a slow rebalancing, or a pause in new purchases would have significant effects. Capital doesn't move for political reasons. It moves to protect itself from risk. If confidence in US fiscal discipline weakens, even slightly, yields rise further. The dollar becomes more volatile. Markets reprice risk. And the Federal Reserve finds itself under pressure once again to stabilize the system. That usually means intervention, liquidity, balance sheet expansion, and indirectly more money creation. This is how inflation risks stay alive, even when growth slows. It's not always visible in consumer price headlines, but it quietly erodes purchasing power over time. Savings buy less. Assets inflate unevenly. Inequality deepens. Add rising geopolitical tension, trade fragmentation, sanctions, and unpredictable policy shifts, and global investors begin asking uncomfortable questions. Is U.S. debt still risk-free? Is political stability guaranteed? Will future returns compensate for rising uncertainty? When those questions start appearing more frequently, capital looks for alternatives. And increasingly, safety is being defined not as government paper, but as hard assets, commodities, regional diversification, and non-dollar exposure. This does not mean the dollar is disappearing tomorrow. It does not mean the U.S. is collapsing next week. Those are emotional narratives, not realistic ones. What this represents is a slow erosion of trust. China is reducing exposure. Europe is heavily exposed. And the U.S. system depends more than ever on global confidence to function smoothly. Confidence is not infinite, and once it starts cracking, restoring it becomes extremely difficult. The real risk is not a dramatic crash. The real risk is normalization of stress. Higher rates become permanent, deficits become harder to finance, growth becomes weaker, and intervention becomes routine. History shows that financial systems rarely break loudly at first. They bend, stretch, and adjust until one day they don't. So the real question is not whether the system survives tomorrow. The real question is what happens if global confidence keeps fading, quietly, year after year. Because when trust finally breaks, it doesn't announce itself. It simply leaves.